Hey everyone, and welcome back to the AI Tech channel. Today, we're diving deep into a bold claim that's been making waves in the financial world. One analyst is reportedly infinitely long on Tesla, TSLA. Infinitely long? What does that even mean? Is this visionary thinking or just plain crazy? We're going to break down his reasoning, explore the role AI plays in his bullish outlook, and, most importantly, assess the risks involved. Buckle up, because this is going to be a wild ride. Okay. So the core of this analyst's argument, at least as we can infer it, hinges on the transformative power of AI. He likely sees Tesla as not just a car company, but as an AI and robotics company disguised as a car company. Think about it. Tesla has massive amounts of data from its vehicles, a powerful AI team working on autonomous driving, and ambitious projects like Optimus, the humanoid robot. This analyst probably believes that these AI initiatives will unlock massive value for Tesla in the long run. To understand the potential scope of this bullishness, let's apply a butterfly effect analysis. We'll look at the direct, adjacent, and socio-economic impacts of AI on Tesla and similar companies. It all starts with a single promotional article pushing an AI stock in a premium newsletter. Consider this article the butterfly flapping its wings. The most immediate impact? Increased investment in that featured AI stock. If the marketing works, people buy shares, driving up demand, and potentially the stock price, at least in the short term. Think of it as a mini rally fueled by hype. Second, expect a surge in subscriptions to the premium newsletter. A deeply discounted price and the promise of a 10,000% gain? That's a tempting offer for many. Finally, the company's reputation is on the line. A successful pick boosts credibility. A flop damages it. It's a high-stakes game. Now, let's look at the ripple effects in related sectors. This article could spark broader interest in AI stocks generally. Investors might hunt for other AI companies, venture capital funding for AI startups could rise, and public awareness of AI technologies will likely grow. It's like a rising tide lifting all boats. We might also see a boost for the investment newsletter industry, especially those focusing on emerging technologies. If the featured newsletter proves successful, others might see increased subscriptions. And here's a critical one: increased competition for AI talent. As more companies focus on AI, the demand for skilled engineers, researchers, and data scientists will skyrocket. This could lead to bidding wars and a potential talent shortage. It's a challenge many companies are already facing. But it doesn't stop there. The growth of AI adoption fuels supporting industries like data centers, cloud computing, and cybersecurity. All these things are necessary to make AI work. And the socio-economic impact? That's the big picture. If AI stocks and others like it experience significant growth, early investors could see substantial wealth creation. But this could also worsen existing wealth inequalities if access to these opportunities is limited. Think about who has the capital and the knowledge to invest early. The rapid advancement of AI raises ethical concerns. Bias in algorithms, data privacy, and the potential for job displacement are all real issues we need to address. This isn't just about making money, it's about shaping the future. The growing importance of AI could lead to a greater emphasis on STEM education to prepare the workforce for the future. Governments and educational institutions may invest more in these areas. It's about future-proofing our society. The adoption of AI will likely restructure various industries as companies adapt to new technologies and business models. This could create both opportunities and challenges for workers and businesses. Prepare for some major shifts. As AI becomes more sophisticated, it will automate more tasks currently performed by humans. This could lead to increased productivity and efficiency, but also job losses in some sectors. It's a double-edged sword. However, before you rush out and buy Tesla stock, let's pump the brakes and talk about the risks. This analyst's infinitely long position might be based on some very optimistic assumptions. And that's where things get dangerous. We need to critically examine the underlying assumptions and potential pitfalls. First, the technical risks. The article oversimplifies AI technology, portraying it as a universally beneficial force. It glosses over the complexities and limitations of current AI. The specific AI company is described with vague terms, lacking concrete details or quantifiable metrics. This raises concerns that the technology may be overhyped or not as mature as claimed. Remember, AI isn't magic. It has limitations. Unrealistic performance claims are another red flag. The text speaks of disease prediction, hyper-personalized marketing, and automated logistics as if they are immediate certainties. It doesn't acknowledge the challenges, potential failures, or the time required for these technologies to mature and become commercially viable. It's like promising flying cars next year. The field of AI is rapidly evolving. A company that is currently leagues ahead could quickly be overtaken by competitors with newer innovations. The newsletter promises insight into a specific company over the next 12 months, but the competitive landscape could change dramatically. Things move fast in tech. The business risks are equally concerning. The promise of a 10,000% gain over the next decade is highly improbable and sets unrealistic expectations. It suggests a get-rich-quick scheme, which is a common red flag. Let's be realistic, there's no sure thing in investing. The text provides minimal information to conduct independent due diligence. The company is described as a hidden gem, without providing its name, financial data, or any verifiable information. It's like buying a car without seeing it. The text implies that you need the newsletter's information to discover this sleeping giant. This creates a sense of urgency and dependence, potentially leading people to subscribe without proper research. Don't let FOMO drive your decisions. The newsletter provider has a clear conflict of interest. They are promoting a specific company while simultaneously selling their services to readers. This raises questions about the objectivity of their analysis. Who are they really serving? While $29.99 might seem like a small amount, the potential financial losses from acting on poorly vetted information could be substantial. The low price is a tactic to lower the barrier to entry and encourage impulsive decisions. Think before you click. The claim that the company has a strong possibility of cornering entire markets is highly unlikely and suggests a misunderstanding of market dynamics and antitrust regulations. It's an exaggeration. The phrase diamond in the rough is a common marketing tactic. It is used to create the impression that the opportunity is rare, but it is often used to promote companies with limited revenue, unproven business models, or poor corporate governance. Don't fall for the hype. Finally, the ethical risks. The text uses sensational language and exaggerated claims to attract subscribers. This can be considered unethical, especially if it targets inexperienced investors. The identity of the specific AI company is withheld, making it impossible for potential subscribers to verify the claims made in the text. Transparency is key. The text leverages FOMO by emphasizing the potential for massive gains and implying that readers will be left behind if they don't subscribe. Don't let fear dictate your investment strategy. There's no guarantee that the research team, or DR, in Nandogan possess the necessary expertise to provide sound investment advice. Do your homework. While there is no concrete evidence of this, the text tactics could be used to lure investors into buying shares of a company, artificially inflating the price, and then selling their own shares for a profit, leaving other investors with losses. It's a classic pump and dump. So, what's the takeaway? Exercise extreme caution. Don't blindly follow any analyst recommendations, no matter how confident they sound. Do your own independent research. Don't rely solely on the information provided in the text. Conduct thorough research on the AI company and the newsletter provider before making any decisions. Consult with a qualified financial advisor before investing in any company, especially those promoted with such aggressive marketing tactics. Get a second opinion. Be wary of guarantees. Remember that no investment guarantees high returns. If it sounds too good to be true, it probably is. And if you believe the text is misleading or fraudulent, report it to the appropriate regulatory authorities. Protect yourself. In conclusion, while Tesla undoubtedly has tremendous potential and AI is a game-changing technology, this analyst's infinitely long position should be viewed with a healthy dose of skepticism. The potential upsides are significant, but the risks are equally substantial. Remember to do your own research, understand the underlying assumptions, and never invest more than you can afford to lose. What do you think? Is this analyst a visionary or just overly optimistic? Let me know in the comments below. And as always, thanks for watching. Don't forget to like and subscribe for more AI and tech analysis. Until next time.